Well, U.S. natural gas futures slid roughly 7% on Friday, hitting a 12-week low as updated forecasts pointed to milder weather and weaker heating demand over the next 2 weeks than previously expected. The February front-month contract on the New York Mercantile Exchange settled at $3.16, its lowest close since October 17. The sharp drop capped a bruising week for the market, with prices down about 12% on the week after plunging roughly 17% the prior week. The move has pushed the contract deep into technically oversold territory. Looking ahead, price action suggests traders are increasingly confident that gas supplies will be sufficient to get through the remainder of winter. The spread between March and April 2026 futures traded at a record discount of about 3 cents, an unusual structure given that March typically commands a premium due to stronger late winter heating demand. Analysts note that April generally should not trade above March, as heating demand is normally higher in March. The March-April spread is often referred to as the Widowmaker, a nickname earned from its extreme volatility and rapid swings tied to changing weather forecasts, moves that have wiped out traders in the past, most famously the Amaranth hedge fund, which lost more than $6 billion in 2006. Traders frequently use the March-April and October-November spreads to speculate on winter and shoulder season fundamentals. March marks the final month of the winter withdrawal season, while October signals the end of summer injections into storage. In the cash market, spot prices at the Waha Hub and the Permian Basin remain negative for a second straight day, and for the third time this year, as pipeline constraints continue to trap gas in the nation's largest oil-producing region. On the supply side, financial firms estimate average lower 48 gas production has slipped to 109.2 billion cubic feet per day so far in January, down from December's record monthly average of 109.7 billion cubic feet per day. Meanwhile, analysts expect total demand, including exports, to rise from 131.9 billion cubic feet per day this week to 133.1 next week, before jumping to 143.6 billion cubic feet per day in 2 weeks. Flows to the 8 major U.S. LNG export terminals have remained steady near 18.5 billion cubic feet per day in January, matching December's record high average. Even with a brief colder than normal window forecast for January 18 to 20, meteorologists expect temperatures across most of the country to remain warmer than normal through January 25, keeping heating demand and overall gas consumption below typical seasonal levels. Nevertheless, winter is far from over. While La Niña years typically bring milder conditions across much of the U.S., they are also notorious for sudden cold snaps sweeping down from Canada into the central U.S., sometimes even reaching Texas. Many traders see the current low prices as a prime buying opportunity, still anticipating a strong cold spell to hit in February. From a price perspective, the market is still consolidating, but the $3.30 level increasingly looks like a magnet. Gas futures have been under pressure, with February NYMEX contracts sliding to $3.16, a 12-week low. The drop reflects a combination of mild weather forecasts and weaker than expected heating demand, leaving the market technically oversold. Nevertheless, traders are eyeing short-term rebounds, which could lift prices back toward $3.30 or even $3.40, but upside appears limited as long as temperatures remain above normal. Support is nearby at $3.16, with deeper technical levels above the $3 pivot. Should those levels fail, the market could test the $2.90 support, reflecting continued bearish momentum. On the other hand, traders are closely watching for any signs of colder weather. Any sustained colder conditions or supply disruptions could trigger a reversal, sending prices higher, potentially above $3.50 and toward $3.60, signaling renewed bullish sentiment. Please don't forget to comment and show some love for the channel. See you next time.